makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, last week ended with credit fears hanging over global markets. We discuss what lies ahead with our guest. Meanwhile, France downgraded over budget concerns by another major credit rating agency. We're live with our Paris bureau chief, but first, easing trade tensions between the U.S. and China, definitely boosting sentiment. President Trump says he will meet with his Chinese counterpart at the end of the month. Now, telling reporters he had a clear list of demands for the talks.
One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
Let's bring in Alan Wang, our Shanghai bureau chief. So, Alan, we heard some clear demands from President Trump. What are the prospects for these talks?
I think a lot depends on what happens this week in talks between Treasury Secretary Bessemer and his Chinese counterparts in Malaysia. It's hard to see Xi and Trump actually a meeting without some deliverables already in hand. And that can mean what Trump already mentioned, soybeans, you got the rare earths, as well as the fentanyl. And I think on the fentanyl issue, China is highly motivated to do something. It's already back in June, it tightened controls on exports of precursor chemicals. And, basically it wants those 20% additional tariffs reduced at the very least. And on the issue of soybeans, that's an issue that Trump is very highly motivated as well, just because he's been facing a lot of criticism from his main voting constituency in terms of the farmers. Yeah. And, China hasn't bought any soybeans this year after buying almost $13 billion worth last year. But in terms of rare earths, that's going to be a little bit trickier, just because China sees this issue as recently tightening its export curbs, just because the U.S. announced some other measures against China in terms of limits on U.S. exports and shipping tariffs. So that's going to be a lot trickier to sort of resolve, just because this is a big leverage that China has over the U.S.
So, Alan, in terms of the data today, the economy expanded some 4.8% from a year ago. How much confidence is there in China's economic future?
Well, I would say that the third quarter GDP gives the Chinese government confidence that it'll reach its annual growth target of around 5% this year, and probably reduce the need for any immediate stimulus. Outside of that, it's hard to say, just because in the third quarter numbers, there were some nasty surprises, such as fixed asset investment, which contracted, on a year-to-date basis for the first time since 2020, largely due to the fact that there's less investment in the key real estate sector. Yeah. And also with retail sales as well, it grew at the slowest pace since November. That's why the fourth plenum that's happening right now, and it's going to end on Thursday, is so crucial, because investors are going to see whether or not China what it's going to do is galvanize its economy. Yeah. So we're looking for stuff on, whether Xi Jinping will take more measures to reduce the curb over capacity, the anti-evolution campaign, so to speak. Whether or not it's going to reduce China's reliance on Western technological goods, and whether or not it's going to do more to boost domestic consumption. As I said earlier, retail sales and domestic consumption is flagging, despite what happened during the October national holidays, when we saw some really good growth overall.
Alan, thank you so much. Yeah, thank you so much to our Shanghai bureau chief there, Alan Wang. Now let's also turn to the budget concerns in France and to our Paris bureau chief, Alan Katz. Alan, we've seen actually a lot of the French bonds move on the back of that S&P downgrade. How worrying is it for France at this delicate political time?
So the downgrade in and of itself isn't that worrying. As you pointed out, French bonds are down slightly today. I mean, a little bit more than German bonds, but not that much. And so, again, the idea that the ratings agencies, S&P and next week Moody's, were going to downgrade France was already baked in. The surprise was that S&P did it on Friday night rather than doing it a month from now when it was scheduled to do so. Why it accelerated its decision is not really clear yet. But overall, though, it does bring this bigger question, which is that given the sort of compromise that the current Prime Minister Sébastien Lecornu had to make last week, instead of giving up both the or suspending pension reform for a while, and agreeing not to use the decree system to sort of force through the budget. Sort of what kind of budget is France going to come up with, and what does that mean for its efforts to try to reduce its deficit? And those are real questions that are not going to be answered very quickly, though we will have a better sense probably in a few weeks once sort of the amendment phase is through in the budget process. But S&P said that really what you have is a big period of uncertainty, and it's really not clear how much budget deficit reduction France is going to be able to get through in the end, and that's how they justified their downgrade over the weekend.
Alan, we also have quite a big corporate news actually in France with Kering selling its beauty division to L'Oréal in a deal that's almost $5 billion. Does it say more about Kering or actually what L'Oréal's future looks like?
So it's really much more about Kering. So Luca de Meo, who is the former CEO of Renault, who came in as Kering's new CEO in September, this is the first big deal under his mandate. It's not clear whether he was behind this deal or if it started before he got there. We've heard people say both things. What it is it's a move to say that Kering really needs to sort of focus itself on the areas that it's good at, which include fashion and eyewear, and that its effort to sort of move into beauty, which started, I believe, in 2023, wasn't perhaps I guess it certainly doesn't have the scale that it needs to really be able to compete on that level. And this deal, which allows it to sort of partner in the beauty space with L'Oréal, that's their main business, puts the beauty in the hands of the company that really can produce it, and allows Kering to focus on some of its other areas that it really needs to fix, namely Gucci.
Great. Thank you so much, Alan Katz there, our Paris bureau chief. Quite a lot going on, of course, in our different bureaus. Now we're joined by Lale Akoner, market strategist at eToro, and Dana Al-Battaji, our managing editor for credit in EMEA. So thank you both for joining us. I mean, it just feels like, all weekend, Dana, we were looking at, what happens Monday, what happens with some of these credit concerns. I mean, could it be that we're two and done, or are we going to see a lot more turmoil this week?
I think so. Markets are priced to perfection. Spreads are so tight. So any sort of bad news would really be bad for the market. I mean, we are seeing a lot of volatility, mostly because people are nervous about how tight these spreads are. I don't think that we're done. I mean, we definitely know that there's a lot of bad credits out there. We definitely know that there's a lot hidden, specifically because of the growth in private markets. So we don't have that much visibility of how bad it is. So these things will come up. However, I will say that everything that has cropped up thus far has been very idiosyncratic. It's not been market-wide. It's been very company-specific.
Yeah, so Lale, I mean, I guess the big concern is that there's some kind of mountain of defaults that just waits to unravel. What's your take on it?
Sure, I totally agree with Dana. We do think that this is just headline-driven risk repricing based on very idiosyncratic, very one-off events. That said, let's be clear that we are approaching the end of the cycle. Yes, the macro backdrop is stretching it a little bit, but there will be incidents like that where, because of the very easy financial conditions that we have seen since, I would say, 2010, there might come up, these types of issues might come up again in the future. We look at places of weakness such as, again, subprime auto loans. Commercial real estate has been a concern for us for many years, especially the distressed portions. And we also look at, obviously, consumer credit. But we are positively assured that the regional banks said that their consumer credits quality are stable, non-performing loans, charge-offs, they are all sort of at very stable levels right now.
So, Lale, where do you think we are? I mean, do we still have a lot of pain, or do we still have a lot of things to shake out? And could it be in 2-3 months? Or do you think we're actually done through the worst, full stop?
I think I'm quite positive, again, because of the macro backdrop. The fact that the Fed started easing and there is massive fiscal stimulus coming into the picture, especially for next year. We are going to see 150 billion consumer aid coming in February as in the form of tax refunds. And that will go to the average U.S. consumer, right? So that will help, say, retailers, banks, and just consumer discretionary in general. And on top of that, as I said, easy monetary policy intact. We're saying 5 rate cuts by the end of 2026. However, that said, I think until we feel them in the macro, there could be some volatility because of the fact that the markets are, say, very concentrated. Earnings season is very on in terms of pressure on these mega cap names. If you are going to give a cautious guidance, your stock is going to suffer. That price to perfection is a little bit worrying for us.
Dana, what's your team looking at today and this week?
So we are obviously monitoring private markets to see what's happening there, and loans as well, just to see if there's any stress in those markets. And of course, we are seeing this bounce back because, as you said earlier, there is a lot of optimism in markets. However, I would also kind of go back to what you were saying earlier and just kind of add that a lot of corporations, a lot of lenders don't want to see a default wave. And so what private markets have been doing, and they've been doing very well, is they've been basically doing everything they can to avoid a default. And I think that we will be seeing much more of that, so that then if something does crop up, it's because you've got fraud allegations or if you've got something big that they absolutely can't deal with anymore.
Lale, is there something in the earnings season, can we go back to now looking at the earnings season if this kind of like calms down?
Sure. Look, for earnings season, we are really looking to see whether that strength in earnings is going to broaden both down the cap scale for, say, small to mid-cap companies, but also across sectors, right? I'm really hoping that we will get good results from financials. Banks have been very positive, apart from insurance. I want to see, again, materials, industrials coming into the picture, thanks again to the fact that, the macro cycle is being stretched as well. There will be pockets of strength in consumer discretionary and laggards such as energy, such as consumer staples. Again, we want to look at consumer strength, pricing power of companies, whether their operating margins are coming under pressure or not due to tariffs.
Is there anything that looks at like .com levels in terms of valuation that we should worry about, where we could see a little bit of air coming through?
I am not worried about a bubble in AI. In my opinion, AI has an earning power. It is poised to increase profitability of corporates, productivity of corporates and employees, and therefore it has earnings power, as opposed to, say, .com, where the market was pricing in hundreds of companies being profitable, where, in fact, they had no earnings power, they weren't profitable, they had no cash generation, and they had no scale as well. These handful of companies have proved to us that they are scalable, they are persistent, they have immense amount of cash flow right now. Now the first derivative is coming down, so the free cash flow growth is coming down. We will take a look at that, but ample amount of cash as well. So I am not worried. I'm not even comparing it with .com at the moment.
Dana, when you go back to the credit and actually look at some of the fault lines that we're looking at, it's always like the second and third round effects. Mm-hmm. Do we have a full understanding of what these companies, who they were exposing to?
See, this is exactly the problem. And because markets have become so complicated, and specifically with private markets, it's hard to know where the pain point is and where the pain point will end. And I think that's what makes everybody so nervous. So as soon as something comes up specifically like, anything to do with private markets, like a bad private market loan, and then they realize how many people are impacted by that, it reminds them that we don't have visibility in this space, and that's one of the issues. However, I will actually go back to the fact that a deal like EA, where JP Morgan was confident enough to give a $20 billion commitment for that takeover deal, for that take private deal, that is the same market that we're in right now. And markets are flush with cash. There's tons of money out there. So even though you do have these risks, and everyone knows that they don't know exactly how those risks will play out, they're still willing to buy these bonds.
Lale, is there anything that you see as weakness? Probably not linked to credit, but there are industry groups that, just because of the way they're put together, could be under more pressure.
Sure. Again, insurance is a concern for me. Yeah. I think costs are coming higher because of all these storms and disasters, and therefore claims are increasing. It has been a weakness, so we will look at other companies that will be reporting in the next few weeks. Energy is another one because of obviously decline in energy prices. We still haven't seen a meaningful pickup in earnings growth. I think those are the sectors I would like to.
I mean, how's the consumer doing, and especially the U.S. consumer? I mean, we have to remember we're also in a government shutdown, so actually there's not much data that we can look at to give us an indication of what the Fed could do, but also the health of the economy.
Sure. I mean, just looking at the banks, for both large cap banks and regional banks, I was very, again, positively surprised that consumer credit is very strong. Credit spending is strong. Delinquencies are low as well. So obviously, the concern is if layoffs increase, that will come under pressure. And obviously, we also want to see how inflation will happen in the future and therefore how it will impact consumer spending as well. That's an area of concern. My opinion is consumer discretionary stocks are oversold right now. They are undervalued. And once these macro drivers are going to be felt in the economy, we will see those sectors coming to the picture in terms of performance.
Wonderful. Thank you both for joining us. Lale, Akoner, their market strategist at eToro, and Dana Al-Baltaji, our managing editor for credit in EMEA. Now, coming up, cockroaches in credit become the talk of global markets. As we just discussed, we'll discuss if more are hiding in the corners. Robert Dafforn from Polus Capital Management joins us next, and this is Bloomberg. Well, let's turn now to the credit troubles that rattled global markets on Friday. My next guest told Bloomberg earlier this year that we were in the foothills before a fountain of defaults started to build. That, of course, was before Jamie Dimon's warning of cockroaches and lending standards. And those worries escalated after credit losses at two U.S. regional banks. Let's discuss all of this with Robert Dafforn. He's Chief Investment Officer of Opportunistic Credit at Polus Capital Management. Robert, thank you so much for joining us again. In May, you told us that you believed we were in these foothills before the mountain of defaults started to build. After the summer, actually, banks and private capital firms were stung by a series of high-profile bankruptcies. Where are we now in terms of that mountain analogy?
Well, thanks for having me again. I think we're just still gradually climbing the foothills, to be quite honest with you. It's been an incredible pickup in leverage over the last 15 years. And what we're seeing now are only those initial indications of misallocation of capital that are coming to the fore because we've been in a period of slightly higher interest rates for 2 to 3 years now. We're starting to see decent level of bifurcation in earnings that we know of, bifurcation in the economy. And those things are creeping into this gradual growth in defaults. Naturally, we will see at what point that eventually becomes something that accumulates into something slightly larger.
Robert, how long do you think until we see the peak of defaults?
Honestly, that's very, very hard to tell, and it may not be a statistic to be worth watching, to be quite honest with you. The actual level of defaults that you would see recorded these days tends to be actually the level of hard defaults rather than those that incorporate kind of effectively situations where creditors are taking losses, but perhaps are just amending and pretending into the future or conducting liability management exchanges to convert a stressed credit into something that is still outstanding, hasn't gone through default, but is unlikely to pay later. So I think the relevant statistic is going to be how many defaults and shadow defaults are there in the system. Will we actually be able to count those in private credit? Will they be accurately reported? So I actually think this time that the following kind of what looks like a default rate might actually not be as worthwhile as it has historically. We'll have to look at those other signals, things like bank charge-offs, which continue to slowly rise, consumer delinquencies, etc., and so on and so forth.
Yeah. So if you look at, the pain threshold, is it more banks or actually private credit firms that will suffer the most?
Or actually expanding that to other parts of the market. I think, look, typically the banks do tend to syndicate their more levered risk. So, there are pockets of leverage everywhere, and what's going to matter is which of those misallocated pockets of credit becomes the issue. I think in the banking system, we know that there is an amount of lending and leverage facilities into the private capital market. So there is that link between private credit and the banking system, via the leverage on those funds. So they're not immune from the issues. Obviously, what we also know is that private credit funds have actually been buying a lot of the syndicated risk rather than that the banks produce, rather than actually kind of self-sourcing that risk. So in the end, they own a lot of relatively similar risks also. So, but I wouldn't say that those are the only pockets of issues, right? I mean, there's a lot of leverage in the system, be it leverage, via margin in the stock market, on crypto, but let's not, of course, forget the high yield market where those weakest exposures are as well for the corporate market. So I would actually expect potentially all of those different pockets to suffer some issues at some time. I think ultimately what matters is also going to be the liability structure of how that debt is owned. I think people often think private credit is going to be immune from issues because these are closed-end vehicles, and therefore they don't necessarily have that run on the liabilities that you can have. But ultimately, these funds do have to sort of effectively send their money back to their investors at the end of the fund life, and that will be a very interesting process for us to see.
Robert, are there any sectors actually that you worry most about for defaults? I know there's been a lot more interest in, for example, software lending, which is facing pressures because of AI.
Yeah, I mean, it's actually quite a few different corporate sectors for various different reasons. So thinking cyclically, there are a number of weak sectors from that perspective. You only need to read the headlines to understand it's not that strong conditions for many of the highly cyclical interest rate sensitive sectors. So building materials companies globally are finding it relatively hard at the moment. We know the same of developed market chemicals companies. There's been a lot of headlines over the challenges for that sector recently as well. So I think you can actually go much more simply and think, well, which sectors are to some extent struggling in this cyclical environment, because we have a very bifurcated world on the earnings side at the moment. But I think it goes without saying that over time we will be seeing losses in the software sector. I mean, I think artificial intelligence as a theme will see some relatively interesting credit losses, partly because of kind of stranded assets that will eventually emerge on the kind of harder asset side. But on the software side, potentially those situations which where the coding has been done more cheaply and hence the product replicated via those systems. So certainly that having been a big area of growth for the leveraged credit and private capital markets is why it poses a risk over the coming periods. But that may actually be a sector that incurs losses slightly later than the more obvious cyclical ones with this bifurcation.
Robert, thank you so much. As always, Robert Dafforn there, Chief Investment Officer of Opportunistic Credit at Polus Capital Management. Coming up, Israel strikes Hamas in Gaza and suspends all aid shipments. We discuss the state of the ceasefire next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump lists rare earths among his top issues with China as a trade truce nears its expiration. France gets a second credit downgrade, with S&P stripping the nation of its AA rating. Plus, Japan looks set for its first female prime minister, with the ruling Liberal Democratic Party expected to announce a coalition deal over the coming hour. Now, Israel says it has resumed a truce with Hamas in Gaza after heavy fighting over the weekend. That's as both sides accused each other of breaching a deal brokered by U.S. President Donald Trump. Let's bring Jumana Barsechi in Dubai. Jumana, bring us up to date with developments on the ceasefire.
Yeah, well, Francine, an intense week of fighting on both sides. And what happened is early on Sunday morning, Israel blamed Palestinian militants and Hamas for an attack that took place on an IDF vehicle that ended up killing 2 soldiers. In response to that, the Israeli Prime Minister vowed a very strong reaction. And that came throughout the course of Sunday with over 100 airstrikes administered by the IDF on various parts of Gaza and Rafah. They also temporarily suspended the shipment of aid, and up until now, the Rafah crossing is still closed. Now, the Gaza government media office says that Israel has killed at least 97 Palestinians and injured 230 since the start of the ceasefire. That being said, Hamas officials have said that they are committed to maintaining the ceasefire and that they had actually lost contact with some of those militants that were operating in Rafah, that it wasn't themselves or Hamas the militants themselves who had conducted those attacks. By the end of the evening, Israel said that they were committed to enforcing the ceasefire. This is where we are today. So the ceasefire is still holding, still very tenuous situation. President Trump was asked about it on Air Force One. He also said that he believes that it's going to hold up. But again, a very fragile situation here. And of course, a lot still to be done, Francine, in terms of implementation of the rest of the points out of that Gaza peace plan that came into being a week ago.
Jumana, have we heard from the U.S.? What are they doing about it?
Yeah, well, so we know that some of the heavyweights, the mediators, are going to be flying back to the region again. Steve Witkoff alongside Jared Kushner, who were key to getting the Gaza peace plan agreed to in the run-up to Sharm el-Sheikh. And then J.D. Vance, also the vice president, weighed the possibility of also coming to the region as well. And I think key here is the U.S. want to keep the momentum going. They want to make sure that there are no further violations of the ceasefire. And let's also not forget that even though we have seen the return of the living hostages, there are still 16 bodies yet unaccounted for. And there's still a lot of pressure from the Israeli government on Hamas to retrieve the remainder of those corpses, which many of them are actually unaccounted for and buried deep, deep beneath the rubble. At the same time, of extreme importance to the international community is the resumption of humanitarian aid. As I just mentioned, the Rafah crossing is still closed. There has been a resumption of aid, but not to the extent that is required. And then beyond that, security considerations with the establishment of an international security force with the likes of the U.S., other countries looking to participate as well. As of now, to be stationed in Israel, no boots on the ground in Gaza, which is what the U.S. have said. And then finally, and this is a major point of contention, how exactly they're going to disarm Hamas and the steps to get that done, given Hamas have been resisting calls for complete disarmament in the absence of a full withdrawal of Israeli forces from the Gaza Strip. They still occupy or control around 50% of it. So still a lot of daylight, but certainly focus from the Trump administration to keep the ceasefire alive, Francine.
Jumana, thank you so much. Jumana Bersachi there in Dubai. Now, Ukraine's President Volodymyr Zelensky says the war with Russia should be frozen along current battle lines before the two sides can enter into peace negotiations. President Trump has urged Zelensky to accept Russia's terms for ending the war, despite weeks ago saying that Ukraine could win. Well, our next guest says Europe is facing an unprecedented moment for its security, and the uncertainty is changing the future of the continent's defense and technology sector as well. We're now joined by Alex Ferrara, a partner at Bessemer Venture Partners. Alex, thanks so much for joining us. Look, if you look at the defense investing and actually defense industry, it's gotten like a huge amount of momentum in Europe. I mean, are we overestimating or underestimating how much this sector can thrive in Europe?
I think it's the appropriate amount of estimation. We have been investors in defense tech for a decade in the U.S., and over the last 18 months, we've started to become more active in defense tech investing here. And it's really for three reasons. One is we've seen this dramatic commitment increase by NATO for 5% of GDP among the 31 of the 32 member states. The second is we really are seeing changes similar to the U.S., changes in the way procurement is happening. And the third, we're seeing just the nature of warfare has changed dramatically and the economics of warfare as well. So I think while there's a lot of excitement, I think it's warranted.
Yeah, what does that mean in terms of investments actually in Europe? I know that if you look at the budget, for example, this was a real game changer from Germany. We're not going to really see that money until maybe next half of next year and then well into 2027. What does that mean for companies?
Sure. Well, we try to invest at the very early stages. We try to invest at the inception stage where possible. So these companies that we're backing often take 10, 15, 20 years before they ultimately go public. And so, we're looking at a pretty long-term time horizon. So if it's 5 years or 10 years, I mean, that's something that's compatible with the way that we look at investing in these startups.
Yeah. Do you need consolidation amongst the big defense companies in Europe for the startups to have a little bit more space?
I think there are, not necessarily. I think the pie is growing. We've got a number of very large primes in each of the, in many of the major countries. Those companies, those primes have seen dramatic increases in their market caps. I think, Rheinmetall, its stock price is up 27 times over the last 4 years, which is, that alone is a venture return. It's dramatic. And we've seen now a growth of the pie. And so while I think those companies, the primes, will have a lot of success, I think we expect some of the neo-primes, some of the more emergent startups are also going to have an opportunity to fill the gap that exists around specifically some of the AI and software-defined innovations that are needed by warfighters on the battlefront.
Alex, just 4 or 5 years ago, defense was a dirty word, right? It was arms, it was dealings, and now you need it to rebuild, I guess, a more secure Europe. But how do you make sure that you're not giving to the bad guys, weapons that are dangerous?
Sure. Well, I should say, we don't invest in munitions. So, we're focused on defense tech. There are elements of war tech as well. But, I look at it somewhat differently. I think that combat, I think we can all agree, combat is probably the one job that we would like to see replaced by robotics and automation. And so, by, deploying these autonomous, drones, whether it's air, land, or sea, I think long term, it's probably going to be something that has potential to save lives rather than create more destruction.
So what are you focused on? Is it like air defense or is it drones,
sure.
recognition?
We have, it's a pretty broad area of focus. We have 5 specific areas. We're looking at drones is probably the centerpiece, and it's both air, land, sea, as well as space. We're also looking at command and control software, which is the software layer that's needed to control this increasingly autonomous fleet of drones. We're looking at space tech, which is, I think, increasingly space sovereignty is viewed as critical for national security. The satellite constellations that the U.S. has, that Europe has, are critical for both commercial applications as well as military use cases. And we're also looking at advanced industrial manufacturing, including rare earths, which has been in the news a lot lately in terms of the fact that China has such a stranglehold at this point on the production of them.
But Alex, when you look at robotics, but also drones, does it not mean more casualties on the ground if these wars are just fought on that ground?
It's hard to estimate how that will play out, but I think as we look more and more at what's happening in Ukraine as a model, we're seeing the deployment of these low-cost fleets of autonomous drones, autonomous boats, submarines, and it's in many ways that has become this autonomous fleet has become the front line, and so the hope is that it actually can reduce the number of lives lost because you will have more robots fighting the fight rather than humans.
Yeah, I think that's still debatable, but maybe there's a hope. Alex, when you look at, some of the things that I know is being discussed in the corridors of Brussels, is how can you be less reliant on the U.S. given the unpredictable nature, actually, of this allyship, and we don't know what happens in 1, 2, 3 years.
Yeah.
Could European defense stand alone without Starlink, without some of the American technology that at the moment is really at the center of everything we do in Europe?
Sure. Well, I think Europe is going to need and is working on its own answer to Starlink and its alternatives to things like Starlink. I think in many ways this has been a wake-up call, and when we speak with people in the ministries of defense or government, they look at this in the optimistic case as a potential path to prosperity. Europe has really struggled in terms of a shortcoming on GDP growth relative to the U.S. Per capita productivity has really lagged over the last 15 years. A number of things have been attempted, but as a technology investor, I'm of the belief that productivity and innovation really are going to be the drivers for future prosperity. And the hope is that, much like we saw in the U.S. in the in the 1950s and 60s, that we will see dual use opportunities where many of the innovations that are coming out of the front lines of Ukraine ultimately will be used for the commercial sector. And whether that's something like, the drone capabilities that our portfolio company Auterion has developed, being used for things like food delivery or deliveries of medicines into far-flung reaches where they're inaccessible today, or whether it's some of the technologies around aerial defense that could perhaps be used in applications such as self-driving cars. The hope is that this could really drive prosperity for Europe.
Alex, thank you so much for joining us. Alex Ferrara, they're a partner at Bessemer Venture Partners. Now, Japanese stocks have rallied on news that the ruling Liberal Democratic Party will sign a coalition deal later today. It paves the way for Sanae Takaishi to become the country's first female prime minister. Now, let's get more on that story with Alistair Gale, our Japan economy and government reporter in Tokyo. So what more can you tell us, Alistair, about what we can expect later today?
Well, probably in the next half an hour, we can expect there's going to be a signing ceremony for this new coalition. We learned earlier today that this smaller party, Japan Innovation Party, was going to join with the ruling Liberal Democratic Party into a new coalition. They've reached an agreement after a weekend of long talks. They found ways to kind of resolve their differences on policy. And we expect really in the next half an hour that all to be formalized.
What can we expect? What do we know about her leadership style, Alistair, and how will it be very different from previous prime ministers?
Well, I mean, it's obviously historic because she will be the first female prime minister. If she survives a vote tomorrow, I mean, there is a process where Parliament will choose the next prime minister. We fully expect her to win that. We know that she admires Margaret Thatcher of the UK. She wants to be a strong leader. She's a social conservative, but she also believes in strong economic measures to try and improve Japan's growth rate. She's talked about government spending. She's been critical in the past of the Bank of Japan for its interest rate hikes. Or at least the course that it's planning to take to raise interest rates. So we're expecting her to be look for ways to kind of expand the economic support measures. This is, of course, a coalition. She will have to negotiate with the coalition party. But I think she's looking to start with a bang, and we'll probably hear more from her tomorrow evening.
Alistair, thanks so much. Alistair Gale there, our Japan economy and government reporter in Tokyo. Coming up, cashing in, Kering sells its beauty division to L'Oréal as part of a strategic shift. Details next, and this is Bloomberg. Well, Kering has agreed to sell its beauty division to L'Oréal in a deal worth €4 billion. It's the first major strategic move by Kering's new chief executive, Luca de Meo. Well, joining us now is Andrea Felsted, columnist for Bloomberg Opinion. Andrea, if you're in the know, you would have known or expected that something big like this could happen. But a lot of people are saying $5 billion. Why didn't they do it earlier? Is this just a new chief executive getting in charge and kind of marking his point?
Yes, exactly. Kering wanted to build in beauty. It bought Creed. It paid a very high amount for Creed a couple of years ago. But the reason for that was to build a platform so that it could gradually take its beauty businesses, the biggest one is Gucci, in-house, and have its own beauty business in the same way as it's done with eyewear. So Luca de Meo has come in and completely reversed that strategy.
So what can we expect from Luca de Meo? I mean, again, this is a car man that's now in charge of Kering, but he's bold. He's going in like fast and furious.
He is. And I think obviously he's struck this deal. Kering has around €9 billion of debt. He needed to do something to bring the debt down. But I think there's a bit of a message here that he is going to come in, make quick actions. When you're a luxury brand that builds for the long term, and a great reason for success in luxury is being able to build and see into the future, if someone's going to come in and make quite sort of knee-jerk decisions, that's also a bit of a concern.
Yeah, I love that. Okay, Andrea, thank you so much. I look forward to your column. Andrea has the best columns because it's brilliant, but also usually funny. Bloomberg's opinion columnist Andrea Felsted, who focuses, of course, on a lot of the luxury companies. Now, staying on the topic of M&A, once you've acquired a company, how do you ensure that it is a success. Well, my next guest has spent his career taking over companies and turning them around. His latest book provides insights into just how he did it and how you can do it too. Well, Charles Skinner's Buy, Run, Build, The Guide to Entrepreneurship Through Acquisition is out, and I'm pleased to say that Charles joins me now in the studio. Charles, thank you so much for joining us. It's a brilliant book because actually it reads like not a self-help, but it's quick. It's quick and it gets to the point and there's no faff. And so once you read it, you kind of say, oh yeah, I should have done that better. What's the one thing that you wish you knew now, or you wish you knew 30 years ago that you know now?
I think the importance of working closely with people, getting people on board is absolutely critical to this sort of process. But I think it's also, the book is primarily just to address something which I felt was a gap, which is that people think of entrepreneurs like Steve Jobs or the Hewlett-Packard guys, and if you want to set up a business, if you want to be an entrepreneur, you've got to start from nothing. Starting from nothing is really, really tough. Your chances of success are very low, you're not going to get paid, a lot of things are going wrong. So actually it sort of struck me, one of the biggest courses at Harvard now is entrepreneurship through acquisition. And I didn't feel anybody had addressed that. And what I like to suggest to people is that buying a £2 or £3 million business, and I explain in the book how you can buy it for nothing, that's the way to get going. And if you really want to run a company, be the boss, it's a much better way than sitting at your kitchen table going, what can I do? Will anybody buy it?
But Charles, is it different? We were just talking about, the new Kering boss. I mean, this is a man that, had a vision, and certainly I met him a couple of times. Like he's always known what he wanted, right? No matter what sector. Is it different being a leader of a listed big company or in management at like a junior level or like mid-management to be an entrepreneur?
I think management is the same in whether it's a family company, whether it's big, whether it's small. Clearly, when you get to very large companies, it becomes quite a lot of matrix management and a lot of stuff, which is why I've tended to specialise in small companies. Once it gets towards $1 billion of value, I'm not the sort of person to run that sort of business. So it's about realising those things. I think the other theme in the book is that I've been running quoted companies for 30 years, taking very small ones to quite larger, and I had a disaster. And that disaster in 8 months taught me far more than I could have learned. We have a sign on.
What did you learn?
I learned what my weaknesses were, where my blind spots were. When something gets into trouble, you've got to really expect everything to get worse and worse. You realise that people can be great people. When there's trouble around, you've got to look after them because everybody's going to behave pretty badly. So that was actually the genesis of this book. I started writing it to work out what I'd done so wrong in 2007. And those lessons, when I started writing the book in 2008, to go, why was I so useless? So,
Charles, do you think you could have saved the company? Or done it differently?
Absolutely. I mean, I'm a bridge player, and I described it. I was dealt an abysmal hand, and I played it appallingly. And from that, the next company I got involved with was a small quoted company worth 1 or 2 million, and it got to a market cap 500, 600 million, primarily through acquisition. And I'm a sort of buy and build person. But it's interesting how I'm very thrilled that the son of a friend of mine, he and a partner, one worked at Goldman Sachs, the other worked in private equity. And I had a long chat with them about life. Now they're running their own business, which is a vehicle leasing business in the Northwest, and doing brilliantly. Classic retirement sale. I'm really excited about how you can rejuvenate companies, particularly at the moment when it's actually quite tough for sort of older business owners. They're getting hit with taxes everywhere, and you need energy to run those things.
But it also seems, and I have a lot of CEOs on the show, that you get told, well, it's a legacy company. I mean, even if you make toothpaste that everybody needs every day, it's still a legacy company. So it's only the sexy stuff that's AI. Like, actually, how do you stick up for companies that we use day to day, or things that we need as humans?
Okay, I've worked in tool hire, laundries. I store bits of paper in cardboard
real
boxes.
Stuff, Charles.
Oh, God, yeah. I'm UK's biggest office removal firm. Yeah. I mean, I got involved in when we had the box business, and then I ended up with the removal business because I bought the removal business because it had a lot of boxes in storage. And then I was poking around the back of one of their sites, as I normally do. I let everybody get on with it, but I like to sniff around. I saw all this old IT equipment, and I thought, how does this work? So then, a year later, we bought a little, very small, 2 million turnover business, IT recycling. We sat on it for 2 years to sort of go, how does this market work? And now we're the biggest IT recycler in the UK. That's it's practical stuff. It's all the same things. People are a lot nicer in blue-collar businesses than they are.
Is there a danger that people just want that look too much into the new technology?
I think that there is a place. There's a huge place for new technology, and certainly a lot of the people who I'm encouraging to buy into old-fashioned businesses are up to speed on AI, things like this, and that can rejuvenate them. But the technology sector is not the only sector in which you can take something, as I've done in the past, very small, grow it something large, partly through acquisition, become national champions, and have a lot of fun with less risk than you might do from trying to set up your own app or whatever.
Charles, I mean, you started by saying it's always the people. Everybody always says it's the people. So what have you learned about dealing with people? Do you have to get them on board from the start? Is it convincing?
In Buy, Run, Build in the book, which takes you through all these things, one of the things is when you go into a business that is in trouble, there are three types of people. The first type are good operators, and they're going, hey, this isn't working around here. Where do I go to next? The second lot are a real pain. They say, Charles, why? This is wrong. What are you going to do about it? It's a nightmare. Yeah. The third group of people, perfectly sensible, who go, I turn up, I get paid, I'll do my job. The people you really want are in that second group. The ones who are a pain, who are going, Charles, come on, what are you doing? You're doing it wrong. Those people care. They care about themselves, they care about the business, they want to get it right. So when you're going into a business which is in trouble, look for those people. The other two groups, nothing wrong with them, but look for those people, because they're the people who are going to be in the trenches with you.
Charles, we just have a little bit of breaking news. So we understand that Amazon Web Services has suffered widespread disruption today, Monday morning, that affected services on other platforms. In a ex-post, formerly known as Twitter, Robinhood said, for example, it's investigating the issue as the AWS outage impacts its services. We understand that multiple other platforms, Snapchat, Roblox, Fortnite, Verizon, are also experiencing issues. That's according to Down Detector. I mean, in a day, since you've been on air, I've had like 55 breaking news.
I'm so admiring how you do your job.
But as a CEO or an entrepreneur, how do you cut the noise away from what you need to do day to day?
I think I'm very keen on locking power and responsibility together and driving it as far down the organisation as possible. So my divisional managing directors, I expect them to deal with everything. Right. I have time. I like to go round all of our sites, which is a waste of everybody's time apart from mine. I like to have space and time so that when something blows up, actually I'm around. That's how I approach it. And then that if say if all of a sudden your biggest customer tells you that they're pushing off, so I've actually got time to go, how the hell did that happen? And get stuck in. So I always think a CEO's got to have time.
So you can't micromanage?
I can't. And I need people around me who are really good. And absolutely, I push everything down to everybody else, but always give them responsibility, but never forget the power. Give them power. Get it down to the people in the workforce. They will do amazing things if you let people get on for it. Just make sure you lock power and responsibility without power is dreadful, and power of responsibility, we know. That was actually what the press barons were called, I think. The harlot's prerogative.
Charles, thank you so much. Charles Skinner, their CEO of Restore and author of Buy, Run, Build. Up next, we have Bloomberg Brief. Again, watch out for the story with Amazon Web Services saying they suffered widespread disruption this Monday morning. Then we have quite a lot going on, of course, in the markets. We talk about credit. And a reminder, we forget, but actually we're still in U.S. government shutdown. It's week 4. This is Bloomberg.